what's the big trend for the Indian markets? Let's try to decode that with Siddharth Vora, who is the head at Quant Investment Strategy and Fund Manager at PL Asset Management. Hi Siddharth, good to be speaking with you. A very good afternoon. And first up, a very interesting report by you where you're highlighting the scenarios why it's time to be bullish on Indian markets. Give us first your sense that amidst this volatility, amidst so many announcements related to tariffs, the RBI monetary policy, the earnings season not expected to be doing any good this time, but why are you that bullish on the Indian markets? What are the data points you're tracking?
Sure. So I think we can look at it both, from a more macro and fundamental perspective and a quantitative perspective as well. So from a macro perspective, I think what was bothering India, right? A, high valuations, B, slowdown in earnings growth, C, the whole exodus of FIIs. So basically, weak growth outlook, uh, rich valuations, and diminishing liquidity. If I look at the scenario now, right, macro numbers, whether it's GDP, PMI, GST, I think all of that is on a front is improving. From a valuation perspective, large caps, are no more expensive. They are cheap, despite the 5-7% recovery rally that we saw. Large caps still continue to trade at a fair valuation. They are neither expensive nor dirt cheap. Mid and small caps were trading at a very rich premium, around 40% to historical averages. They are close to trade 15% premium versus historical averages. So I think a lot of froth has come off. Again, that's not to say they're cheap and the opportunity is very lucrative now. So valuations are no more such a big concern as they used to be, say, 6 months back. From a domestic and global liquidity, if you see the measures RBI has taken over the last 6 months, right? 3 to 4 rounds of liquidity infusion has been done in the system. At the same time, we've also seen rate cuts to the tune of 25 basis points. So from a domestic liquidity perspective, also things are improving. And the earnings sentiment is likely to be better 2 quarters forward, simply because we've come out of a low base. The tax cut is going to put in more income in the hands of the customer, in the hands of the spender. And the whole effect of the whole Kumbh Mela is yet to be seen playing out in the economy. Over and above that, we are also going to see government capex to start reflecting, whether it's infrastructure, defense, capital goods, railways. Across the board, we're going to see the impact of government capex, which was quite subdued. So I think from a macro and fundamental perspective, things are not bad anymore. A lot of the bad news is in the price, and things are starting to improve. If I support this same argument with the quantitative signals and data points as well, I think 4 or 5 things are really interesting. First, we've looked at the history of the different bear markets in India to find out that the bear market, like we saw in the end of 24 and beginning of 25, was an absolutely domestic focused bear market. There was no global contagion here. And what that also means is domestic focused bear markets usually are mild to moderate, which would mean 5% to 20% for a majority of instances. It is only when the bear market takes the nature of a global contagion that these are severe corrections. Severe would mean anywhere between 20 to 40%. So currently, except India, for the last 12 months, every other major global market has done very well. So India was the sole underperformer, so to say. So I think because it is not a global contagion so far, it can be based on how the tariff policies come out. But so far, it hasn't been a global contagion. And hence, despite the volatility, going on to cash might not have justified. We still should have been equity focused. Secondly, we look at cyclical and non-cyclical sectors, right? We track how these two sectors are performing versus each other. And again, very evident that now cyclical sectors are likely to outperform. Just to give you an example, non-cyclical sectors are sectors like consumer staples, FMCG, pharma, healthcare, IT to a certain level. These sectors did quite okay in the whole bear market sell-off. But it's now the time to look at cyclical sectors, whether it's power, cap goods, infra, defense, uh, real estate. Some of these sectors are likely to do better as we go into the next phase of the market. So our cyclical, non-cyclical indicator is saying that we've bottomed out there. Cyclical sectors have
Right.
bottomed out in terms of underperformance. So I
Right.
think that's a very interesting point.
Right, Siddharth. Hi, good afternoon. Ankita also joining in. The couple of things you mentioned there. First, there is a sense of valuation comfort in the market now. India has been an underperformer compared to its global peers, and also the fact that going ahead, we could see a couple of things playing out. Whether it's the rate cut, the liquidity infusion, or the earnings getting better. So now, are you saying that we are out of the woods, and from here on, we have better days ahead, and the worst of even the Trump tariffs has been priced in the market?
No, I don't think the worst of the Trump tariffs have been priced in the market. Again, tariffs are going to be very sector specific, right? So whether it's pharma, IT, auto ank, some auto OEM which have a large global export, some jewelry and diamond exporters, to a certain extent, chemicals and textiles. So it'll be a very sector specific movement. So irrespective of the Trump tariff, there you could see a sector rotation play out, right? People will move to more domestic focused sectors rather than stay invested in sectors which are vulnerable to Trump tariffs. So from a sector and a market cap, it is best to be able to stay nimble and to be able to diversify in this phase. You can't take a very high conviction call on large caps just because they are relatively cheaper and there's more valuation comfort, because they are extremely vulnerable to foreign flows, news flow and fund flow. Mid caps, on the other hand, they are a little expensive, but they are still quite resilient because they are focused on the domestic economy. So I think finding that balance in the portfolio across cap sizes, across sectors vulnerable to tariffs and sectors completely resilient to tariffs. I think that's the job we must all be doing right now. And also, I did not say that there's valuation comfort. I only said that there's no valuation discomfort anymore.
All right, there's no valuation discomfort as we speak right now. But Siddharth, all's point taken, but talk to us some numbers with us. Give us some sense that what sort of a move are you anticipating from these levels when it comes to the benchmark indices and within the sectors that you were just highlighting between cyclicals and non-cyclicals? Any particular sector where you believe that the move could be very good or it's worth highlighting? A crisp answer is what we are expecting.
Sure. So I think our momentum low wall indicator tells us that historically, on a 12-month forward basis, we've seen a median return of more than 30% every time the momentum factor crashes as much as it has right now in this cycle. So the momentum factor has crashed in the 30-35% zone. And usually we've seen that every time it crashes to this level, 12-month forward return with a 90% probability is north of 30%. 24-month forward return with a 100% probability is also north of 25% CAGR. So I think from a return perspective, this is one way to quantify it. Even from a market breadth perspective, we see, market breadth was down to historical lows on a rolling 6-month basis. So again, there is a 80% plus probability that markets give a very sharp return from this point on from a 12-month, 24-month forward basis.
All right. Siddharth, you also mentioned a couple of sectors. Sectoral churn is what you mentioned. You mentioned power companies and so on. You mentioned cyclical and non-cyclical, stocks. But talk to us about financials. I didn't see you mentioning financials. Do you see value in the financial space? Because there has been an underperformance in the last 3 years, and there are a couple of names are even trading below the price to book. And especially if the rate cut comes on, from the RBI, then it automatically benefits the PSU names. Do you see valuation comfort also? And is it a good time to get into the financial space?
So financials do constitute the largest allocation in our portfolio since the last 3 months. We've stayed out of financials for a good 15 months before we started entering very aggressively. So as we speak, I think roughly 25-30% of my portfolio is focused on financials, whether I talk about high quality lenders, whether I talk about NBFCs of the highest quality, whether I talk about gold finance companies, I think financials are a significant part of our portfolio. I think simply because from a valuation, growth, quality, and volatility, from all perspectives, they fit right into the portfolio, into the top quartile of all the quantitative indicators that we track.
So that we let you go on that note. Thank you so much for taking the time out and sharing your perspective on the markets as well as the sectors that look good to you. Really appreciate that.
If you like this video, then like, share and subscribe to ET Now.